Hey, founders, Kirk Mitchie with Candor Advisors. So the update, the comment this week, and I know a lot of you are, already well into your summer vacation or have other stuff going on. So this may hit you weeks from now. It's okay. It's going to be a persistent issue, and that is the finance bros are coming for your business. And the question is whether that's a good thing or not. And so what do I mean by finance bros? Okay. What has happened, if I can summarize and take a little poetic license here, is in the last couple of decades, the returns from traditional investments have not been that thrilling to ultra high net worth investors. And financial advisors, private equity professionals are having a tougher and tougher time enticing people to invest in more traditional kinds of things like mutual funds and ETFs and things like that. And so there's a whole segment of these folks that have now created independent sponsor models or search funds or buyout structures whereby the latest thing is that they're going out and convincing investors that they should invest with them when they go in and buy your company. And the pitch goes something like this: we're going to buy, this company that does 10 million of revenue and 2 million of EBITDA, or transferable economics. And if we can buy that business for, say, $10 million, 5 times its EBITDA, we have a 20% yield. We get the 2 million a year by spending $10 million. And, we're going to work with the founder and we're going to structure it so that we don't have to put all the 10 million up front. We might give that guy $4, $5, $6 million up front. He'll roll some equity, retain some of the business, participate with us when we sell the business for $20 million down the road, and we all make double our money plus whatever we make through leverage. And so they go out and they convince investors that this is possible. And on paper, it is. There are a number of challenges to this. First, many of them have never bought a company before, much less have any operating experience in the businesses they're buying. So these financial models work on paper, but any of you entrepreneurs know there's a lot more to running a business than keeping the financial trains running on time. The second thing is there is a huge buyout community, far more experienced than them, who's out there trying to buy businesses at the same time, and they're all competing for the same deals. The great news for you as a seller, that can work for your benefit. If you can create some competitive tension out there to drive the price and terms higher and better for you by using those competing forces. So the other piece to this, though, is that because they've never gone through the process of buying a company, they've definitely never gone through the process of selling a company, much less handling the investor relations and making the day-to-day decisions as entrepreneur owners as you, the founder, has. So what ends up happening here, to quote Henry Kravitz from 10, 12 years ago, any fool can buy a company. The important part for you, if you roll equity or take an earn out or take a seller note, is that whomever buys your company needs to be able to get to that second sale, that second bite of the apple. And the likelihood that these finance bros are going to get to that second bite of the apple with no experience, no matter how smart they are, no matter how well-intentioned they are, is lower than a traditional private equity firm that has lots of experience doing that, and probably lower still than a strategic buyer who's in the operating business of running a business in your business or adjacent to your business. So this is a new kind of buyer, and a new kind of buyer and a new source of capital is great. That means there's more demand, there's more money out there. That's good for you as a seller. The cautionary piece here is type of buyer, buyer experience, structure really, really matters. So take a closer, harder look here and make sure that you and whomever you're using, whether it's an M&A lawyer or a transaction advisor like an investment bank like Candor Advisors, make sure that they're doing parallel due diligence on your buyer or hopefully multiple potential buyers to see not just who's going to pay the highest price and give you the best terms, but who's got the lowest risk to close, who can fund the transaction, what's the highest probability of matching up these deal terms with your why as a seller. Look, if we can help with that or anything else, navigate over to candor-advisors.com. In the insights section, there are dozens and dozens of free videos that can answer a lot of your questions. And the green call to action button, talk to Kirk. Feel free to click on that. Tell me a little bit about your situation, how you think we might be able to help, and we will respond right away. Thanks a lot. Have a great week.